Okay, sorry about that. I was talking to Zach, in the office. Zach is in the office today, and I am at home, so you might see a little bit of blur from the background there. So welcome. It is 15th of November, and we are live right now. So if you have anybody have any questions, any real estate questions, any mortgage questions, any questions about anything, feel free and add those to the chat. And so I'll see that and be able to answer any questions. And I do have an announcement today. I do want to start off with an announcement or a request. How about that? I'm going to start out with a request. And I just want to say that I am Tim Habib, and I'll just give you a little bit of background about myself. I've got 20 years experience in real estate. I'm a licensed real estate agent, licensed lender. I'm also a lender, and I am also an investor. I have some rental properties and an Airbnb, and I'm going to help you with all those things. So if you have questions about investment properties, if you have questions about Airbnbs, if you have questions about how to finance a investment property, if you have a question about real estate, if you have a question about anything, just put that in the chat. Also, I just want to say that, so announcement. We are actually looking for people to join the team. That's what I wanted to say. We're looking for people to join the team, and we really got an opening for three types of people. The first one is just an appointment setter. So that would be like a remote work environment. You don't have to be in Colorado. You don't have to be in Denver. Just anybody. If you're looking for some remote work, we have too many leads coming in, and we just can't keep up with them. So we're really looking for someone to just call our leads, set up an appointment, set up a 5-minute appointment, set up a 15-minute appointment with me, and you would get paid by the appointment. So if you're looking for a little bit of side work and you're working from home, you have that ability to make calls, get a hold of me. Maybe send me an email, and that would be Tim D. Habib. Tim D is in David, HABIB @gmail.com. So just contact me, and if you're interested in that, we can talk and see if that would be a good fit for you. We just got too much coming in, excuse me, and I just can't keep up with it. So the next one is if you're interested in the mortgage business. So it's interesting right now is probably not the busiest time for mortgage originators, but that's probably when you want to start. You want to start before it's like super busy and kind of get your feet under you, and we can help you out with that. So if you were thinking about a career in the mortgage industry, and maybe you're a real estate agent. To be honest with you, I was a real estate agent for 20 years, and then I got my mortgage license. So if you are a real estate agent or a non-real estate agent, but you're interested in the mortgage business, we're looking for people to train. And what would that involve? You would have to get your license, and that is you would take a course, and it's not too bad of a course. You would take a national course, finish that course, and then you have to take the national test. And that's what a lot of people get slowed down. You have to take that national test, and people kind of are hesitant to take that test until they feel like they're completely ready for it. Well, that test is, you have to score like a 75% on it. And if you don't pass that test, you have to wait 30 days to take the test again. So it kind of freaks you out because you're like, I don't want to take the test until I feel 100% sure. Well, one thing I can do for you is help you pass that test. So we've got some really good, since a few of us have taken the class and then passed the test, we have the right resources to get you through that. And if you follow our resources, we'll get you to pass that test. I can almost guarantee. I can't guarantee it because you got to actually do the studying, and you have to, show up and take that test and drink your coffee that day and be ready to take the test and pass it. But I believe I can get you from starting the training to finishing the test in 30 days. In 30 days, you will be licensed nationally to originate loans. And then what we would do is you'd come on the team and we actually have leads. I said we have too many leads. Well, you would then kind of take over some of those leads. And so we would be helping you with leads already to get started. So it's actually getting set up in a career. So if you want to talk to me about it, again, timdhabib@gmail.com or my phone, 303-949-5669. I don't know if Zach, I don't know if we can have that on the, maybe have that on the screen so anybody could call and email me. So that if you are interested in getting in the mortgage industry, I would love to talk to you, see if it's a fit for you. It's not that expensive to get started. We might be able to fund that and then take that out of a deal that you do later on. But you have to commit to it because you have to do, the studying, take the class, study for the test, and then pass that test. So I would definitely help get you through that and establish yourself in the mortgage industry. And then you come on our team, and we would work together and funnel you leads. And we would help you build your pipeline, but you'd have to be, then making the calls. And we have a training center you could work in, or you could work at home. We have Google Meet, and we could just be working remotely together. So, and then the third one is actually if you are an established MLO, an established mortgage loan originator, specifically in retail, what we call retail, which is like a bank or credit unions. We have the ability, I'm with Nexa Mortgage, which is a wholesale broker. And so we have access to 250 lenders that we can, source the product from, instead of, say, just the bank or, just the products that you have access to. So for instance, we can actually do hard money loans. If you were an investor and you want to do investing, we have access to hard money loans. So we have access to 250 lenders, very immediate. We just go on to Zoom and can talk to the account executive. So if you are interested in that, now, of course, the issue is that you have to then start supplying your own business, right? You have to generate your own leads. Well, we can help with that. Again, we've got too many leads coming in. Sorry, I got a little cough today. We do have the leads coming in, and we have the ability to generate more leads. So we can help you with the lead generation. And one thing that Nexa does, this is really interesting, they have a class called Retail to Nexa. So we would actually, talk to you and say, hey, this is how the transition would be from a retail environment to Nexa, which is a wholesale environment. And one of the things that you could do, one of the things that we offer is a free trip to UWM. Who is UWM? If you are an established MLO, I'm sure you know who UWM is. The UWM is the largest lender in the country that nobody knows about because it's a wholesale lender. If you own a home, there's a 25% chance that your loan would now be with UWM. So they're making about, I think it's 25% of the loan volume in the country right now. And we actually take a trip to UWM. It'd be a free trip, and you would see how we would work with this specific lender. Now, we don't have to work with UWM. If you have a borrower, we have access to those 250 lenders. But if it's a good fit, what UWM does is they just make it really easy to interact with them. And if they have the best rate, if they have a good rate for that borrower, you would use them. And they then bring you into their office and show you how to work with their software. It's a fascinating company, and it's a great trip, and it would be free. You'd be able to meet the folks at UWM. You'll be able to meet the folks at Nexa, and so if you have an interest in that, would love to talk to you. Again, timdhabib@gmail.com or 303-949-5669. So that's the announcement on people we're looking for. So we are just looking for some good people to join the team. So if you have an interest in that, let me know. So I don't see any questions yet. I don't. Let's see if any questions have come up. If not, I am going to go over a few topics that I've actually had people ask me this week. So this week I've had a person that asked me kind of an interesting question. So it was an older person, and they just said, what would be the best use of the equity in my house? I've got a lot of equity in my house. What would be the best use for that equity? And what they also were asking is, like, what are my options? I have this equity. I've been in my house for 20 years. The value of it's gone up tremendously. What options do I have? And what is the best option? So I'm going to give you a list of 6 really good options for the equity in your house. And the best option is really, obviously, it's dependent upon you and what your plans are for the future. So one of the things that I just saw recently, I think it was 92% of Americans want to age in place in their home. So if you're looking to age in place, there's several options. If you're looking to move somewhere else, to another state, we're here in Colorado. If you're looking to move to Florida or Arizona or California or Mexico, overseas, then that's going to be a different option. If you're looking to move into, let's say, assisted living, that's going to be a different option. So let's look at these 6 different ways to utilize the equity in your home. So the very first one is to just sell your house outright, right? That's going to unlock the most equity in your home, is to just sell it outright. Now that means that you are moving, either downsizing to another home locally, you're moving out of state, or you're moving into assisted living. And the reason I say that is because you can't do a reverse mortgage unless you live in the house. So that's not an option if you're looking to move somewhere else. If you're looking to do a downsizing somewhere locally, or you're looking to move out of the house. So that first option is just to sell it outright. So what options do you have? You can put it on the market with a real estate agent like me. And I do work with folks all the time, and I offer a discount. I will only list that house. I will list that house for only 1% listing fee. So, and it would be a full service listing, professional pictures. Again, I've been doing this for 20 years. I've done, I think, 40, between 40 and 50, I should count it sometime, between 40 and 50 fix and flips. So I've listed my own properties. And so professional photos, I will negotiate, absolutely pure, 100% full, full service listing for just 1%. And why do I do that is because my overhead's fairly low, and my the company I work for has fairly low. There's no split. I just pay a fixed fee at a closing, so I can keep that commission low. Okay, so 1% listing. So let's say you're going to sell that house, instead of, some people say, oh, it's a 6% to have commissions. Well, it's going to be 1% on the listing side, and then on the buying side is whatever we come up with. We'll negotiate that. Typically, tradition is 2.8, but that's changing now. So you might say 2.5, you might say 2, you might just say, I'm not going to pay anything. Let them make an offer. So anyway, the listing side would be 1% if you're going to sell that house, and I can help you with that. I can help you get it fixed up, help you get it cleaned up if you need that. That's the other thing. I've done so many fix and flips that I can help you get that house ready to sell. I've got contractors that can come in, we can clean it up, we can, paint it, we can do some landscaping if that's what you need. If not, if it's ready to go, 1%. So that's the first use of your equity, is to sell it outright. Now, let's say you want to stay in the house. Okay, let's say you want to stay in the house and age in place, or you want to stay in the house and do some work on the house. The next option is a cash out refi. Well, a cash out refi would be if you have an existing mortgage, we would get a new loan on the property, pay off that existing mortgage, and now reestablish either a new 30-year loan. That's the traditional cash out refi. So let's just say, hey, the house is worth $500,000, and you owe $100,000. So typically on a cash out refi, you can get up to 80% of the appraised value of the house. So let's say it's a $500,000 house and appraises for $400,000, and you owe $100,000. You then would get a loan for $400,000, pay off the $100,000, and make the payments on the $400,000. So you would extinguish that existing lien, have a loan for $400,000, and you would clear $300,000 in equity that you could use for anything else: college, tuition, buy an investment property, whatever you want to do. Now, what's the downside to that? The downside is obvious, and it's obvious as to why these aren't happening nearly as much as they used to. It's because you probably have a 4% loan, existing loan, 4, 3, 5%, and this new loan is going to be at the current rates, which as of today are at about 7.5% or 7.4%. So your payment would be quite a bit higher than what that existing lien. So that might be a shock. It might not be a good time to do that refi right now, right? You might want to wait for rates to come down. A lot of people, that's what they're doing. They did a refi when the rates were at 2.5%, 3%, excuse me, 4%. And now rates are 7.5%. So it doesn't make sense to do a refi unless you need that cash and you are wanting to do that refi to pull the cash out. So that might not be the way to go for you right now. So what's another option? The other option is to do a HELOC, or a home equity line of credit. Now, there's pros and cons to this. One is that, again, let's go to the property that we said is worth $500,000 and you owe $100,000. Again, you can go up to 80% of the appraised value at that HELOC, so you could go up to $400,000. So you could borrow $300,000 on a line of credit. Now, the good thing, the pro about that, is you don't start paying on that HELOC until you actually use it. So you could establish that line of credit and not use it. And you don't have to make payments then until you actually use it. So you could establish that line of credit without equity, and then you might say, hey, my kids are going to college in a year. That's when I'm going to use that line of credit, and I'll use it as they go to college. I don't know what scholarships they're going to get. And I say this because I am in that boat. My son is a high school junior. I'm sorry, high school senior. He's applying to colleges. He's applied to, all sorts of colleges, CU, School of Mines. He's applied to CSU, Michigan. So we don't know what that is going to look like. And we also don't know what scholarships he's going to get. He's got perfect grades. He's very sharp, very high on the SAT score. So hopefully we'll get some scholarships, but we don't know at this point. So so we might say, hey, we need to get some money lined up with a HELOC on our property, and then when we find out how much he's going to need, we would be drawing from that HELOC and then making payments based on when we take it out. So the downside to that is HELOCs are a little bit higher interest rate. Okay, so you're going to pay a little bit higher interest rate than if you did a cash out refi. So instead of 7.5%, it might be 8.5% or 9.5%. Who knows? It depends on your credit score, and so we would have to look at that. But that interest rate might be a little bit higher on a HELOC. But it's a really good tool to use with your equity, and you just have to look and see which way is better for you. One thing I do want to go back to that on the cash out refi, I say it has to be a 30-year loan. It actually doesn't have to be a 30-year loan. You don't have to restart your whole loan process. You might say, hey, I only want to do a 15-year loan. You could do a 15-year loan on a refi. You could do a 30-year loan. You do a 20-year loan. You actually can do, there's lenders right now, you actually can say, I want to do a 27-year loan. You can do any loan length you want. We have products to say, hey, let's say you want to do a refi and you've actually been paying for 9 years, and you say, I like that. I'm kind of comfortable with it. I got 21 years left. We can do a 21-year loan. So, I mean, you would kind of, it's very flexible. We have very flexible loan products right now. So you don't have to restart the 30-year. You can go a little bit shorter or whatever you want to do. Okay. So those are the main products that you're going to use if you're going to age in place, if you're going to sell it outright and move into a nursing home, move out of state. The one thing about the HELOC is a lot of people would use it for, let's say you're aging in place and you want to have that property, your home, a little bit more comfortable for you as you get older, right? You might have stairs and you may want to put in a stair lift, an elevator. I don't know about an elevator, but whatever it is that makes it more comfortable for you to be living in that house. If you're in a wheelchair, maybe you need a wheelchair facility, ramp, or maybe you need to do some remodeling to make it that you can live on one level. Well, that would be a good product to use, the HELOC, to do that remodeling so that you can stay and age in place. That's the beauty of it, is you're going to say, hey, I'm going to make this property work for me for the next 20 years. And so that's what you would use that for. Now, here's the downside, right? Here's the downside to that product is now these are what we call a forward mortgage. Now you got to make payments on that. You're going to be continuing to make payments on these loans for the next 30 years, 20 years, whatever it is. And so your payment potentially is going to go up because you went from uh, a loan that had a balance of that you got when you bought the house at 200,000, and now the balance is going to be 400,000 with a higher payment, substantially higher payment maybe. So what are some other options for that equity? And we're going to get into the one that has had, for some reason, well, for several reasons, has had a bad reputation, and that is a reverse mortgage. And the reason it's had a bad reputation is because in the late 90s, early 2000s, they just weren't as regulated as much as they are now. So it was kind of the Wild West when, Tom Selleck was on TV, and I think it was AIG, or is that what it was? AAG? And I think it was AIG. And so it was a private product at that time. And so what were the downsides to that? One is they didn't explain what the reverse mortgage is. They didn't educate you as to what you had to do to perform to not get in trouble with that reverse mortgage. And they also really ramped up the costs on the front end. They charged as much as they could on that front end, and really it was a very expensive product, and they didn't educate the consumer as to what they needed to do, what their end of the bargain was. And so there were actually, and they didn't tell you, hey, this thing can go into foreclosure. They just thought that, hey, I'm getting money, I don't have to pay it back. And the product was not regulated the way it is now. So what has happened is FHA has taken over this program and has completely regulated it and given really good guidelines and made it a much safer product than it was in the 90s and early 2000s. So it actually is one of the absolute best retirement planning tools you can use. And if your financial planner says that it's not, it's because he may not understand the guidelines these days and the safety that it has. So let's talk about the reverse mortgage a little bit, because it's going to be a very good tool. One of the things people don't know about a reverse mortgage is that there's 3 different options on getting paid. And these 3 different options are a line of credit, a lump sum, or a what we call tenure, or a monthly payment. People think it's always just been a lump sum or a monthly payment, but there's actually a line of credit. This is a beautiful planning tool. So let's say you are 62 years old. It's the minimum age to get a reverse mortgage. You can actually apply for the reverse mortgage, and you would get a principal balance based on how old you are and how much equity is in your house. Well, at 62, you don't get as much as you would when you're 82, that principal balance. But guess what? Let's just say you set it up as a line of credit. You're going to pay to set that line of credit up, but that payment's going to come out of the balance, right? So it's going to be, let's say you qualify for $200,000, but you don't take it. So you pay to have it set up, but then you have a line of credit that, get this, it's going to grow over the years. And it's a very minimal annual cost to continue that line of credit. I mean, it's just a very minimal cost, as long as you don't access that line of credit. So let's say 10 years from now, 15 years from now, all of a sudden you need money for a medical emergency. You need money for whatever it is. You need to renovate the house. That line of credit is going to go up in how much you can borrow against it. So let's say in 20 years, it's going from a $200,000 line of credit to $400,000. We would have to look at that and see what that is. it's going to go up at a certain interest rate every year as to how much you can borrow against it. Okay. So that's one way you can use the reverse mortgage very effectively in retirement planning. So another way you could do that, let's say you just say, hey, I've also got a 401k, I've got investments. I'm going to use those as I retire. Well, guess what? What if you have a bad year? What if those stocks are actually going down? What if you have a really bad year and those stocks go down in value and you have to be selling those stocks and you're like, I don't want to sell them. I know they're going to come back. You actually can suspend selling those stocks, let's say, and then implement that line of credit and take that money from the line of credit and suspend payments from another account, let's say. And say you do that for a couple of years. And you take that money from the line of credit as your living expenses, whatever your expenses are that you need to live on. And then in a couple of years, those stocks return, and all of a sudden they're making all sorts of money. Guess what? You can then stop taking money from the reverse mortgage, the line of credit, and get this. You can actually make payments back to the reverse mortgage. So let's say that stock, all of a sudden it doubled. You're like, oh my gosh, I just did so well on this. Not only can I start selling it, I actually could make payment back to that reverse mortgage. And so let's say you borrowed, I don't know, $40,000 over those 2 years, but you made $100,000 on the stock. I'm just making this up, just so I'm just making these numbers up. You made $100,000 on the stock. You could then say, hey, I'm gonna now pay that $40,000 back that I borrowed on the reverse mortgage. And what does that do? It actually then gives you that borrowing power. You could borrow it again. So you can actually pay a reverse mortgage back and borrow it again. So this is why I call it it's a retirement tool. If one account is not doing so good, you can use this until it is doing better. Now, the other thing about a reverse mortgage that's interesting is it's not taxed. The reverse mortgage is not income that's taxed. If you're selling a stock, potentially you're going to have to pay capital gains on that. But with the reverse mortgage, you don't pay capital gains because it's a loan you have to pay back. Okay, so you're not taking the equity out and paying capital gains on it. Okay, so if you were to say, sell your house outright, you potentially have to pay capital gains on that. But with the reverse mortgage, you don't. And so you can really be using this as a tool, a tax planning tool. The other thing you can do, one of the things you potentially could do is at 62, you say, hey, I'm gonna take a little bit out of the reverse mortgage for a few years so I don't have to get Social Security. I want Social Security. I'm eligible for it, but I'd like to get the higher payment when I'm 70 instead of at 62, 63, 64. Well, you could take that money out of the reverse mortgage product to delay getting your Social Security payment. So then when you do get it, instead of getting, again, I'm throwing a number out, $1,400 a month, you might get $2,000 a month or $1,900 a month later on. So you'd have to look at that and say, hey, is it worth it to do that? So these are some of the tools. Or you could take a lump sum. You can take a lump sum out of a reverse mortgage. It is limited, and this is one of the things that FHA has done, is that now they limit that lump sum. It used to be you could take the whole lump sum that you qualify for. Let's say you qualify for $200,000. People were taking that lump sum completely out and spending it on, who knows what, cars, cruises. You took that money out, and now it's gone. Now that money's gone, and so here's the thing about a reverse mortgage. you do not have to make payments back on a reverse mortgage until you leave the house, either through moving out of the house or you pass away. But what you do need to do is pay the taxes and insurance and maintain the house. Okay, so you do have to pay taxes. You have to pay insurance, homeowners insurance, and you have to live in the house. Now, you don't have to live in the house 100% of the time. Guess what? You could, let's say you're in Colorado, you can spend half the year in Colorado in your house and have a reverse mortgage on it, and spend half the year in Arizona. Maybe you rent a condo. Maybe you spend half the year in Florida. You only have to spend half the year in the property to have that, to be eligible for that reverse mortgage. Okay, so you don't have to be there all the time. So you can really use it as a retirement tool. And so let's say you took that lump sum out. So this is what was happening. People are taking that lump sum out, right? They're taking 100%, they spend that 100%, and now they don't have enough money to pay the property taxes and homeowners insurance and maintain the house. And so what was happening is there were foreclosures. Okay, there are foreclosures on reverse mortgages, but because it's really interesting. A forward mortgage. So let's just go back to a forward mortgage, a normal mortgage that you get the money, buy the house, and then make payments. As part of those payments, the lender is going to escrow taxes and insurance to make sure they're paid every month. Okay, so when you set up the loan, you're going to escrow or put money into an account to fund the taxes and insurance, and then every single month, when you make that payment, you make a PITI, principal, interest, taxes, and insurance. And then the lender is making sure that money goes to the property taxes and insurance so that the property taxes are paid and they won't lose the house. You won't lose the house. Well, with a reverse mortgage, those are not automatically paid. You have to pay them, okay? And I'm going to tell you a story about what happens if you don't pay them. So now here's the next good thing about this. We actually can set that up that they do get paid automatically. And guess what? You can use the money from the reverse mortgage and set up an account to make sure that the taxes and insurance are being paid. Okay, so it can be done, but you have to prove that you have the ability to make those taxes and insurance payments before you qualify for that loan, or we take that equity and take a chunk of it and have it set up to pay those taxes and insurance. Well, one of the things that also weren't being done back in the 90s and early 2000s, there was no education. Now with reverse mortgage, you are obligated. FHA requires you to go to a home buyer education, a reverse mortgage education class taught by a HECM approved counselor. Now HECM, that's the first time I've said that. I don't know if you've heard the word HECM, but HECM is the FHA approved reverse mortgage. Okay, it's the FHA reverse mortgage that has all the guidelines that the FHA requires of lenders to make sure that it's a safer product. Okay, so HECM, home equity conversion mortgage, is what we call it, a reverse mortgage now. So when you hear me say HECM, it's a reverse mortgage. But it's specifically a FHA reverse mortgage. You can get a reverse mortgage from a private mortgage lender that is not an FHA HECM. And we can go into that a little bit, that it could be a good product for you because there's certain things that the FHA loan can't do. So so you would be looking at the reverse mortgage product. You would take this educational course required of you to make sure you understand what's going on and what your obligations are. So in the past, they didn't have it. So I'm going to tell you the story, kind of a sad story, but this happened, I think it was about 2 years ago. We had a family contact me, and the family contacted me and said, hey, our mother just lost her house to foreclosure. She has a reverse mortgage. Is there anything we can do? And how did this happen? We thought that this couldn't happen. We didn't understand that she could lose the house. How did this happen? So I went to the house with another real estate agent that I was working with at the time, and we just said, okay, let's meet at the house with the mother and kind of figure out if there's anything we can do to get the house back, and how did this happen to her? Because this is what you hear. You're afraid, oh, if it's a reverse mortgage, the bank's going to try and take that house. No, that's not true. It's not true at all. But it is a loan. It is a loan that needs to be repaid. And the only thing that bank has as collateral is the house. Any loan you make, the house is collateral for the loan, right? A forward mortgage, a reverse mortgage. And so when you sign that reverse mortgage document, it says you have to pay property taxes and insurance, and you need to live in the house. If you break any of those rules that we have, we can foreclose on you because the house is the collateral for them to get paid back on the loan. So what happened with her is very instructive on how most, well, I shouldn't say how most, but how reverse mortgages can be foreclosed on. So we went to the house, and the woman was like, Mom, what happened? Were you not making whatever property tax payments? What happened? And so what had happened is her husband had died a couple years before. Okay. And guess what? He handled all that stuff. He handled making property tax payments. He handled the insurance. Now, the other thing that's going to happen, a reverse mortgage lender is going to send you something in the mail every year and say, do you still live here? Well, guess what? You have to respond to that. You have to respond to that to say, yes, I still live here. They're just checking to make sure you live there. Because if you don't live there, they can foreclose on the property. Well, she wasn't doing that. And so they were saying, well, Mom, did you hear about this foreclosure? Did you get any notification of a foreclosure? And she said, no, I don't see anything. I haven't seen anything. So I said, that's very odd, because in a foreclosure, one thing is I've done a lot of foreclosure investing, and I'm an expert in foreclosures. The county public trustee is going to be notifying you constantly. Hey, here's your notice of election and demand. Your auction is on this date. You're going to be foreclosed on, and it's coming up, and you need to, they're giving notice to everybody. Well, so I said, are you saying you haven't got any of those notices? She goes, no, I don't remember seeing that. So the woman said, Mom, where's your mail? Where is your mail? Let me look at it and see if there's any notice. And she says, hey, it's on the dresser in the bedroom. Well, the daughter goes and gets the mail. Here's a stack of mail with notices from the public trustee saying she's being foreclosed on, and mail saying you haven't paid your property taxes. And the woman was like, here it is, Mom, you didn't open them. She never opened the foreclosure documents from the public trustee. She just didn't understand it. And so what happened is they were sending it to her that she wasn't paying the property taxes the last few years. She wasn't responding that they lived in the house. So the lender is saying, hey, we see that the property taxes are delinquent. We see that she's not responding, so nobody's there. That's how they know whether you're there or not. Now, the other thing that they know is if you pass away, there's actually a database of a list that I don't want to get too morbid here, but there's a list of people that have passed away that comes from, mortuaries have to file documentation. So there's a national database that lenders actually access to say, hey, who's passed away? Are they on our list of reverse mortgages? If they are, that gives us notification that they've passed away. We're going to start sending them documentation to see if that's true, whatever it is, So they were sending her notifications. She wasn't responding. They see the property taxes are not being paid. Then they file the foreclosure. And then at that point, it's still potential to save the property. But what happened is it went to auction. She never attempted to do anything. It went to auction. And once it goes to auction, it's gone. Once somebody bids on that property or doesn't bid on it, it'll then either go back to the bank or it'll go to the high bid at the auction, which is what happened. So they said, hey, is there anything we can do? And I said, as far as I know, no. Once it goes to the auction, you'd have to contact the public trustee, which they did. The public trustee was like, no, you've had all this notice. There's nothing you can do. You could, So she lost the house. She lost the house. Who felt worse? The daughter or the mother? I don't know, because the daughter didn't live that far away, and she didn't take any notice of what the mom was doing. She didn't understand the reverse mortgage any more than the mom did as to what are the requirements. Very simple. You pay your property taxes, you pay homeowners insurance, and you respond to them when they try and contact you to say, do you still live in the house? So for instance, if you as soon as you vacate that house, the note is due, right? So as soon as you vacate that house, the note is due. You're going to vacate the house either by passing away or by moving away, moving into assisted living or moving somewhere else. As soon as you don't live there for 6 months or more a year, that note is due. Now, let's say that note is due and you borrowed $300,000. You owe $300,000 on the loan. What happens? Well, you can put the property on the market and sell it. Is there any additional equity in that property? Let's say you passed away and that property goes to your heirs. Those heirs can sell the property and take whatever balance is over the 300,000, right? So they would still get some remaining equity, or they have to pay the $300,000 off that is owed. And why would they do that? Well, let's say it's a $500,000 house. And they say, hey, for $300,000, we can get a loan against this house, pay off the $300,000, and keep it as a rental. We can keep it as an investment property and rent it out for $3,000 a month, right? It depends on the property. So the family actually has the right to pay off the note when you decide to leave the house. Now, if there's no equity left, you can just let it go back to the bank. It's a foreclosure, but what do you care? You're gone, right? I mean, it doesn't matter. You can just let it go back to the bank. So typically, a reverse mortgage foreclosure is when somebody passes away and the family doesn't want the house because there's no equity. So they don't do anything and they just let it go back to the bank. They let it go to auction and they do not attempt to do anything with it because there's no value to it to them. Again, they could sell the property. They could buy the property. It depends on how much the note is and how much equity. So if you get that reverse mortgage and your family saying, hey, we want that equity, well, that's an issue between you and your family. Okay. Who is a reverse mortgage not for? It's not if it's going to destroy your family and they say, hey, we want that equity, we need it 20 years from now or whatever. That's up to you. It's your house, your equity, but you are going to be with a reverse mortgage, you are going to be pulling that equity out of the house. You don't know how long it's going to go on. Look, I don't want to get morbid. You may pass away in 2 years, right? So then there's still a lot of equity in the house. You didn't borrow everything. And the family could then pay off a fairly small amount and keep the house, or they could sell the property and take the equity. Okay, so it's still a great tool. So when would it work for you? Let's say you're on a fixed income and you have all this equity in your house and you want to live a little bit better standard of living as you are aging in your house. You want to be able to go out and have a meal in a restaurant every now and then, or whatever it is, right? This is going to give you a little bit more extra income. Maybe you just have Social Security, you stop working. Maybe you don't have a big retirement account. So now this reverse mortgage is going to be a supplement to your income. And at some point, that benefit's going to run out. You're going to use the principal that you qualified for. So now you've used the principal that you qualified for in the reverse mortgage. But you're still healthy, right? Still got your Social Security or whatever other income you got. Guess what? You don't have to leave the house. You can stay there as long as you want and make no payments. The house is paid off. You're just not getting a payment on the reverse mortgage, but you don't have to leave. You can stay there as long as you want. You stay there another 20 years and never make another payment. You can stay there as long as you're healthy enough and desire to stay there, as long as you want. As long as you make property taxes and insurance payments, right? You got to keep doing that. But let's say you're in Colorado and you just say, hey, I'm going to keep this house for, you live to 100. Live to 100. So another story, quick story. My wife's grandmother just passed away, 106. You could live to 106. You could have exhausted your benefits at the age of 80. But if you can stay in that house till 106, you never make another payment and you don't owe any more than the value of that house. Okay? Your heirs, when you pass away, they only are obligated to the value of the house. Even if you borrowed, if let's say you borrowed $500,000 and the house value goes down to $300,000, okay? Imagine the worst case scenario. You qualify for $500,000, you borrow that, and then the housing market collapses and the value of the house is $300,000. Guess how much they owe? 95% of the appraised value after you pass away. Okay, 95% of the appraised value max. So they would just let it go. They wouldn't even try to sell it because it's not, there's no benefit to it. They would just let it go back to the bank. But they would have no obligation for the $500,000. You have no obligation. They would have no obligation. Okay. This is what people don't understand about reverse mortgages. It's an incredible planning tool. You don't really know how it's going to play out. It depends on how long you live. It depends on where do you want to live. At some point you say, hey, I just can't handle this house anymore. I can't handle the maintenance. I got to go into assisted living. Well, at that point, how much equity is left in the house, we would have to see at that point. But if you could just let it go, right? If there's no equity, you just go into assisted living and there's no equity left. So that is the Heckham reverse mortgage. There's two other ones that are kind of interesting that are very lesser well known. There's actually what we call a Heckham for purchase. Okay, crazy product, a Heckham for purchase. Very few people understand this, even mortgage people, because they're fairly rare. Now, guess what? What's going on in this country? This country is aging. This country is getting older. A lot of the equity in real estate is in people 65 and older. Okay, I'm getting there. I'm very close, right? I'm going to be in that, what we call the silver tsunami, and so reverse mortgages are going to become more and more popular as this demographic gets bigger and bigger. Excuse me. I think they say that there's 10,000 people in the US turning 65 or older every day. Turning 65 every day. 10,000 people. Well, a lot of them have homes, and they're going to want to age in place. I think I said 92% of the American people surveyed want to age in place. And that number is probably 100%, right? It's actually just everybody wants to age in place. Some people just realize they aren't going to be able to. They can't take care of the property. So reverse mortgages, as people understand how valuable they are as a retirement planning tool, this is going to be used more and more often. And the head of FHA just came out recently and said, the absolute best product we have is the HECM for purchase. So here's how the HECM for purchase, some people call it the H4P. You'll see it abbreviated, the H4P, HECM for purchase. Let's say you're in Colorado, you own a house in Colorado. I'm just going to say you own it free and clear, okay? Let's put that value at $400,000. I'm just going to make these numbers up. You have a $400,000 house, no mortgage on it, but it's too cold here. Okay, I get that. You've quit skiing. You're not wanting to shovel snow anymore. So you say, I got to move. I'm going to move. Now you might say, I love skiing. I'm going to move in Colorado, but I need to downsize. Okay, doesn't matter. Let's say you're going to move to Arizona. You're going to move to Florida. You're going to move to the Villages in Florida. That's where my dad lives. He lives in the Villages. You've probably heard of it. The biggest retirement community in the United States. I think there are over 150,000 people. If you have questions about the Villages, ask me. I know, I go there every year and drive around in a golf cart. So let's say you're going to move there and you have a $400,000 house here and you want to buy a house in Florida. And let's say that house is $300,000. Just going to toss a number. $300,000. You're going to downsize a little bit, move to a cheaper place. So you got a $400,000 house. Now, traditionally, what would you do? You would say, I'm going to sell my $400,000 house, and maybe there's I just toss a number out, 10% closing costs. So you're going to net $360,000, right? You're going to net $360,000. Now you're going to go down there and buy that house for $300,000. Okay, so typically you're going to go down there and say, well, I'm going to give you $300,000 cash, and that leaves me $60,000 in my bank account. Well, it's not that great. I mean, it's okay, right? It's good, but maybe you wanted more in that account to put into annuities, put into some interest-bearing account. So a couple things you could do. You say, hey, I'm going to take that $360,000. I'm buying a $300,000 house. I'm actually going to just give them $100,000 down payment, and then I'm going to get a loan for $200,000. So now you got a loan. I'm sorry. Yeah, you're going to put $100,000 down, and then you have a loan for $200,000. So now you've only used $100,000 of the $360,000. So you have $260,000 in your savings account that you can use for investments. You put $100,000 down, but now you got a loan for 200. Now you got to make payments on that loan. And you're like, I'm sick of making payments. I don't want to make payments anymore. I don't want to make any more payments. I paid my house off. I don't want payments. This is where the heck'em for purchase comes in. Here's what you can do. So we got 360. We're going to go buy a $300,000 house. Typically, what you're going to need to do is put about 50% down on that house. So we're going to go down there and put $150,000 down on that house. That leaves me $210,000 in the bank. What am I going to do for the other 150? I get a reverse mortgage, heck'em for purchase. So you're going to get a reverse mortgage for $150,000. So you're going to get a lump sum of $150,000 that you're going to owe in the future. So you have no payments. You put $150,000 down as a down payment. You got $210,000 in the bank, and you got a $150,000 reverse mortgage. Well, guess what? You don't make payments on that $150,000. So you're in this house, $300,000 house. You have no payments until you vacate that house. So you bought this $150,000 house, you have no payments on it, and you have $210,000 in the bank for your investments. That $210,000 is going to make sure you can pay your, right? Remember, property taxes and insurance. You got to pay those property taxes and insurance. But now you got $210,000 in the bank. The very first way, you only had $60,000 in the bank, you had no payments. The second way, you had $260,000 in the bank, but you got payments on a $200,000 loan. The third way, you got $210,000 in the bank, and you have no payments on the house. No payments. Until you vacate the house. Then you're going to owe that $150,000. Okay, see that? You don't owe it until you die or move out of the house. So the heck'em for purchase is a fantastic tool to keep money in your pocket that you can invest somewhere else. Somebody actually asked this question the other day. This is an interesting question. Can I use that money that I save to buy an investment property to give me a little bit more income? Yes, you could take that $210,000, buy a condo next door to you, whatever. And that condo would then generate, whatever, $1,500 a month. Well, that's free cash flow because you own it outright. I mean, there's all sorts of this. This is why I say it's a tool. It's a tool you can use to do this. Okay? So the heck'em for purchase. We've gone through 5. Cash out refi, HELOC, sell it outright, reverse mortgage, the heck'em, heck'em for purchase. Now there's a little bit of an oddity here. There's actually a reverse mortgage second that you can take out, a reverse mortgage second. So let's say your first is fairly small. It's a $500,000 house. You owe $100,000. You actually can get a reverse mortgage second. Now, if you have enough equity, that reverse mortgage second could actually pay off the first. Typically, if you still have a first and you get a reverse mortgage, the first thing you do is you're paying off that first. But you can get a reverse mortgage second, leave that existing loan in place, continue to make payments, and now you have a lump sum or a line of credit second that you can use. The first is still there. Potentially, you still have this. Now you have this second that you may use for, let's say you need it for a surgery or some health-related issue. You need a lump sum. it's actually going to be in second position. But you don't have to, you get the lump sum, but you don't have to make payments on it till, guess when you leave the property. So that's a rarity, but it is a product that's out there. So you could take that money if you needed it. You had equity in your property. You want to stay in the house. You've got a first. You just leave that, and you have this second that you can use for, let's say, a medical procedure. So there you go. Okay, we've exhausted the equity in your house topic, and but that's really interesting to me. That's a very interesting topic, and I'd love to, if you have any questions about that, let me know. Love to work with you on that. It's actually a very useful discussion that you can have. And what I would say to you is, hey, book a 15-minute call with me and we can go over these options, right? Just book a 15-minute call and let's talk about these options that you have. And that call, you can either set that up, just call me directly, 303-949-5669. So I'm looking to see if we have any other questions. I don't see any questions right now. Hang on, it's about 1 o'clock. We've gone an hour, believe it or not, on mainly reverse mortgages. So I think that's going to be it for today. Well, no, somebody did ask me. Somebody just did ask me last night. Somebody asked me, oh, interest rates are coming down. Yes, interest rates are coming down. And the question is, why are interest rates coming down? Interest rates are coming down right now because inflation is coming down. So the Feds have kind of worked hard at, reducing the inflation rate, and when they tried to bring down the inflation rate, what they did is they brought up interest rates, home loan interest rates. They didn't, but the federal board, raised the cost of borrowing money, which then costs everybody money to lend money. So now that the inflation rate's coming down, and maybe the housing or the jobs market doesn't look quite so good, well, you're going to see interest rates start coming down, and we'll see now. So interest rates were slightly above 8%. Now they've come back down to a little under 7.5. So there's, the prediction is that they're going to be in the 7s, in the 6s, maybe down to 6% by the end of next year. So that's the prediction, but you know how that is. You can never tell what's going to actually happen, right? So we'll see if that truly happens. But yes, interest rates have come down. So to me, it's just still a good time. It's a good time if you're a first-time home buyer, to get into the market before, let's say, if interest rates went to 6%, a lot of people would be in to be a lot more competitive. So anyway, interest rates coming down, probably continue to come down. One of the best times to be a buyer in the market is over Christmas. And why is that? Because nobody's looking for houses. There's a lot less people looking between Thanksgiving and Christmas. Thanksgiving and the first of the year, the market doesn't pick back up activity-wise until about the middle of January. So really from Thanksgiving to the middle of January is actually one of the best times of year to look for a house if you're a buyer. So if you're looking to buy, right now is the time to get pre-approved. Let's start working on your application, get you pre-qualified, get you pre-approved, see how much you're approved for, and get out there and start looking for a house. Okay. I think that's it. Next week, I'm actually going to be talking a little bit about creative financing. Creative financing is kind of a hot topic. We don't have time today, but there's a lot of talk about subject to and creative financing, and can you buy properties that way? Is it a good thing to do to sell your property to somebody? You may have got an offer from somebody, hey, I want to buy your house subject to paying your mortgage or subject to creative financing. And we're going to go in that a little bit. It really is dependent on your point of view, who you are, as to whether that's a good thing. But I will say this, it's a fairly complicated topic, and you really need to educate yourself if you are seriously considering that. Now, you might be an investor. You know, the other thing is there's a lot of investment gurus out there selling courses on how to buy properties subject to. And I'm actually in a couple of groups, and so I've done a lot of research on this. So if you have a question about this, definitely ask me. And if you have a question, if you want to buy properties subject to, you know, give me a call and we can go over these things, because I'm in a couple of groups that have a lot of information. So, okay, I think that's it for this week, and I thank you, and look forward to talking to you next week. And we will be talking about creative financing. I'm not really sure any other topics that I hear this week. Maybe we'll talk about, you know, if interest rates continue to go down a little bit. We do have a new website coming up, a new website that I'll give you the info on the website. We're working on it right now, integrityhomeexperts.com. The other thing is I'm working on an ebook on reverse mortgages and equity in your house. So maybe you want, if you're interested in that, let me know. Working on that ebook now. It's going to be a free ebook for any information. If you want information about reverse mortgages, just let me know, and we can get you on the waiting list to get you in to get that book. All right. Well, thank you, and I think that's it for the day, and we'll see you next week. Thanks.